Gentlemen.
All right, thank you very much, Matt. As Matt said, I'm Erich Patten, the Chief Investment Officer, and thank you all for being here with us this afternoon. We've titled today's presentation, Coming in for a Landing, and that really refers to what is our economy doing? Are we going to come in for a soft landing, which will not have a big spike in unemployment and a really severe recession, or are we going to have a hard landing, which will have exactly that? And that's really the debate that we're having in the markets today. But let's start with some disclosures. And I think it's important that even though Bryan and I are going to be making some forecasts and providing Cutler's opinions today, that those views do change as the markets do change, and that you should always consult with your financial advisor before making an investment decision. But let's look at today's agenda, and we're going to start. Will the Fed achieve a soft landing? We're going to do a third quarter review and our recommended portfolio positioning. So how have we positioned clients for the current economy and the current markets? And then we're going to move on to current events. Notably, will the Fed pivot? Where does the economy stand right now? And will markets rally from here? And all that ties into Cutler's market outlook. But Bryan, why don't you get us started here and let us know what Cutler's doing and kind of how we view these different asset classes here.
Okay, thank you very much. Thank you for joining us, everyone. What we see here is a recap of what I would call the four major categories. It's really, think of it as three, but stocks get broken in two pieces. Bonds had another difficult quarter. We're going to talk more about bonds later, but in general, they have had the hardest year in modern market history. What have we seen some upside from, though? Staying short on duration. Duration's kind of a dry topic, but basically right now we have seen just as much value from shorter bonds as we have from longer bonds as far as yields, and in the longer bonds have been getting whacked on price. We'll have some details there. In stocks, we saw a rally intra-quarter in about August, give or take, in both domestic and foreign stocks. Unfortunately, that didn't last very long. We're in the midst of another rally right now. We'll see if this one has more legs to it. But what we see in both of those areas is kind of a baby in the bathwater thing, where there are some stocks that needed to come down quite a lot. There are some other stocks that did not need to come down quite as much. We are seeing some nice upside there. We're looking at opportunities. Finally, in the alternatives class, there's many different ways to track or to utilize, I should say, that class. We use somewhat of a market neutral approach there that incorporates things like commodities and currencies. That class, once again, has shown to be the strongest performer this year to date, and we're really glad that we have a position there.
Yeah, and as we progress through this presentation, we're going to be talking about bonds and stocks and foreign stocks, and really all of these asset classes, there's reasons to like at these levels today. So, this is a relatively optimistic webinar today. I think it's especially given all of the negative news that we're reading and that we're seeing out there. We want to try to present an optimistic view of why you might want to own stocks and bonds going forward. Alternatives, as Bryan said, have been a great asset class, and they often hedge risk out of the market, which has been very effective this year. That's comparable to what we're seeing in this slide. We're showing our quilt chart. And you can, if you're watching this on your phone, you may not be able to read the numbers. Bryan and I are both on our desktop, so we'll try to walk you through the colors at least, so you can tell what's going on. But tying back into those previous asset classes, you'll notice on the top right of your screen, short-term bonds has been the best performing investment this year. That is comparable to cash, although cash has done much better than short-term bonds. But in a typical year, short-term bonds are cash equivalents. Let's look over the last 15 years, which this chart represents. And you can see short-term bonds have been at the bottom in terms of all of these investments, 1, 2, 3, 4, 5 different times in 15 years. There's another 5 times when they've been in the bottom third. So 10 out of the last 15 years, cash or cash equivalents have underperformed bonds and stocks. This year has been an exception, and it's been an exception in a very big, even historic way. But as we look forward and fast forward the next 15 years, we want to look back and not have portfolios that are heavy in cash and short-term bonds, but instead have portfolios that have yield and growth opportunities through stock exposure. Bryan, let's get the bad news out of the way. This is another really historically awful slide. Bryan, what are we looking at here?
Yes, sorry for the bad news, but let's talk about what has happened this year to date through September. On the left-hand side here, this is a representation of 60% stock, and in this case, we're using all domestic big stocks, 40% domestic bonds. So this is a very typical portfolio mix, especially nationwide. Many of our clients have this as well. What is, excuse me, making this year so unusual and why we are at the top, which would denote the worst year so far for this sort of a mix, is not so much the stocks, right? If you look on this list and look at those years, all of us have probably experienced at least some of those years. Stocks were down as much or significantly more than this year. So what's the difference? It's the bonds. The bonds this year have been down a historic amount, unfortunately, and that can be translated over on the right-hand side. Keep in mind, this is in dollars, not in percentages. So this can be a bit shocking, but it's still important to know. The biggest reason for this drop, that dramatic drop of the red line there, is first because of the percentage drop in asset values. That's true. Also, because asset values are so much higher in general than they were even back in 2004, 6, 8, the other years, right? This doesn't go back to the 70s or even the 90s. This is only since 2004. But we've had such dramatic increases in value that when you have a decrease in value, it looks pretty alarming. But really what is happening here is this is that combination of a stock and bond drop together, which is very rare.
Yeah, and a frequent strategy that investors have had over the last decade or so have been buy the dip. When stocks sell off, they buy, and that's been a very successful approach to investing over the last decade. And in fact, if you look at this chart on the left, it's been a very successful approach for nearly 40 years. This chart shows a 1% decline and how the stock market has done a week later. And you can see pretty much for the last 40 years, since 1980, a week later, stocks have been up fairly significantly. Buying the dip has worked. What about this year? Well, this year's highlighted in red on the left. And if you had bought stocks when they drop 1%, a week later, you would be down over 1% more. That's not an effective investment strategy in terms of trying to time the market and trying to get those dips correct. On the right side, we see the same information, just differently, which is what are the percentage of negative days that we've had in the stock market this year? And just to kind of give you an idea of how negative stock market sentiment has been this year, over 50% of the time, stocks have been negative. Really, over 55% of the time, stocks have been negative. And you can see that's a historically high level. It approaches what we were in the early 2000s. And before that, not until the early 1970s, we'd seen kind of that persistent negativity. Hopefully by year end, if we begin to have a little bit more upside in the stock market, this number could come down before year end, but that is still to be seen. Bryan, what's another what jumps out at you in terms of these declines that we've seen this year and this chart?
Okay, so what we have here is a series of time periods where stocks have dropped 25% or more from their peak value. The first thing that I would point out is the period we're in now is down at the bottom, right? This goes chronological, not by severity, not by degree of drop. The first thing I notice is that the drop we have now is the smallest. I know it's still a lot, but it's the smallest drop of this period. All right, if we remember back to 2000 to 2002, you can see that near the middle, that was almost a 50% drop. 2007 to 2009, more than 50%. But what really jumps out is what happens afterwards. In almost every case, 1 year later, not only do you have a rally back up, but a double digit, very significant one. 3 years later, 5 years later, 10 years later. We don't know the 2020 results just yet that far out, the 2022. A lot of what's happening now is related to events from then as far as cash and stuff such, excuse me, that we will talk about. But really, the two parts that jump out to me here are that the drop that we have does not compare yet, knock on wood, to some of these other periods that also lasted a very long time. And that going forward, there's so much green on here, especially some that lasted even beyond this scale, that on a look forward basis, this makes me feel better about where we could go next.
Yeah, Brian, that's definitely an optimistic chart based on the action that we've seen in the stock market this year. And really a lot of this outcome is driven by this question. Will the Fed pivot? If you read our newsletter, the theme of our newsletter was really about the Fed pivot. What does the pivot mean? It means that the Fed has been raising rates, and you'll see later on, really at a historically fast rate. A pivot means that instead of raising rates, we'll switch to a period of time where the Fed will be lowering rates. And they would lower rates based on economic weakness, but most importantly, based on inflation. And let's talk a little bit about inflation and our expectations for inflation and whether or not that will come down. We'll start with the money supply. Here is M2. Brian, what is M2 money supply?
M2, okay, let's go to Economics 101 class. M2 money supply is freely available cash, right? Well, you think, well, all cash is freely available. Well, not really. Some of it is a bit harder to utilize than others because it might be pledged for loans or other things. M2 is going to be looking at what do we have available, intangible money that can be used for activity. What we see here is the M2 money supply. New money gets printed and issued and delivered out in the form of, say, stimulus checks and such like that. If you look back historically, this chart goes back to about 1960, I believe. And during this time, when we see these significant increases above the average, and let me state up front, having an increase in this money supply is always expected, right? That's why, Grandpa can tell you that a Hershey bar was a nickel back when he was a kid, and now it's $2, right? Having a standardized progression is normal. What is not normal is big spikes up in this value. Well, you can see back in the 1970s and 80s, those happened. That was during times of some financial distress. Then we had another one in 2020, 21. Not only do we have one, we had the biggest of all time. There's many factors that have led to inflationary pressures, that, in my view, is the biggest one of all. What is the good news off of this? We have seen a decline. The additional good news that I just read this morning is the 6-month change is now gone to a negative. We need that, right? So not only do we need to get below the average, we need to keep pushing this value down. That is happening. The news from this morning, I've been a bit of an M2 hawk here. The M2 getting lower, actually not just growing less, but getting lower is great news.
Yeah, and I think getting lower is what the market is looking for. On this chart, there's a lot of data, a lot of numbers. I'll highlight a few and then I'll hand it off to Brian. But what jumps out to me is the July overall CPI number was 8.5, August was 8.3, and September was 8.2. So the trend is for lower inflation. And the top shows the Cleveland Fed forecast for October at 8.04. So again, it's ticking down. The question is it ticking down fast enough? Has the Fed done enough to accelerate this process and to kind of set that lower inflation course on its way, or do they need to keep increasing? And Brian, you've put a square here around shelter, and shelter seems to be really the sticking point. What's so important about shelter in terms of how the Fed can react to these numbers?
Okay, so when we think about inflation, you might sometimes see it broken into two categories. There is headline and there is core. The major difference between them is the core let me put it this way. Headline has all the components of core, plus it also adds in food and energy, which are of course, important, but they tend to be very volatile, which is why we look at them separately as two measures. Okay, well, why is shelter so important to either of those? Even in the lower case, in headline, it's 30% of that calculation. In core, it's 40%. So if you think about that, that means not a half, but it's getting there, of that calculation will be based on changes in shelter. The second part that makes this important to know is shelter is calculated in a very I'll call it unusual to be nice way. They use owner equivalent rent. What does that mean? I get a call one day, it's from a census, and it asks me, hey, Mr. Knutson, what would you rent your house for? I have absolutely no idea. But I know that my house value has gone up. I pretty much know what my mortgage payment is, more or less on a monthly basis. If I still have one, I make a guess. Okay, well, did I make a guess today that was higher than a year ago? Probably, right? And would I make a guess that's higher again going forward? This is what makes this calculation so frustrating, but also so important is first that huge component level, and also it's an area that has still been climbing. I'll just make a quick reference to the chart above and say the Cleveland Fed has been incredibly accurate, and they got September exactly right. But Eric very rightly noted that headline has been creeping down. It's still higher than we need it to be, but it's coming down. What has kind of taken the baton and become the problem child? Core. Why is core staying so stubbornly high relative to its past measures? Shelter. That's what we need to watch out for.
Yeah, and this next chart, it just shows how CPI may not be the most accurate description of inflation, but it is the most common and it is the one that really is driving the markets. But this shows rents, real-time rents on a month-over-month basis. And you can see over the last several months, rents are dropping. Now, shelter is not dropping at the rate rents are, but on the flip side, shelter did not go up at the same rate that rents did in the past. So there was a little bit of a catch-up trade, or a lot of a catch-up trade, as the Fed began to account for this rise in shelter that was happening after we all saw the housing market go up. And now the Fed is a little bit behind the curve as well, or potentially behind the curve, you could say, as rents are coming down. Are they looking at this number, or are they looking at shelter as described on the previous page? And that's something that the markets are arm wrestling with every day, is trying to predict what the Fed is actually going to do based on the different numbers that are out there in the economy. All right, so here's a current projection of what what the market is expecting. And Bryan, you just updated this chart on the left. This is fairly current as of this week, right?
Yes.
Yeah.
This is from yesterday's newest update. And so what this is showing us, the chart on the left, is that right now, the Fed funds rate today officially is 3.08 because it never officially got to zero, but think of it as 3. Okay, next week, we very much expect, so there's maybe a little more bet on a 50 basis point rise, 0.5%, but almost all bets say 0.75%. That would get us to 3.75. Then from there, there's a more dispersion of opinion, maybe call it, which has been one of the big reasons why markets have had lots of very optimistic green days, and then maybe some like today with where it comes down a bit. But why is that happening? One of the biggest reasons why, because of this Fed futures chart. The expectation now is to crest at almost 5 and then start to come down. Keep in mind that this chart does go out to 2025. So this is a very gradual expectation, but that is something that markets need to look at the near term and the longer term to determine what could happen next.
Yeah, and I think this also shows why we're more favorable on kind of that intermediate bond space, because you can today buy bonds in that 5 to 7 year time range with the expectations that this is what the Fed curve will look like. If the Fed curve begins to slope to a greater extent, or the rates go down in the future, those bonds that you're buying today have locked in rates at today's value. And we think extending duration is something that investors should be looking at in bond portfolios today. All right, so let's talk about where does the economy stand and what are the different fundamentals for the economy. That also is related to the Fed because the economy has been strong, and that's given the Fed a little bit more leeway to raise rates as aggressively as they have. Bryan, in your view, is the economy still strong?
It is stronger for the third quarter than it was for the first two, but I'll give you a little bit of a catch. Let me play a little bit of both sides. So did we have 2 straight quarters of slowing economic growth? Yes. Q1 and Q2, they were not dramatically lower. I don't want to exaggerate that point. Nothing near what we saw in 2020 and 21 with those huge whipsaws because of kind of the lack of opening and the reopening. But those were negative. So yeah, did that bring calls of a recession? Sure, of course. But what happened in the third quarter, excuse me, is a rally back up. That green line there, which could be hard for if you have a smaller screen to see, is the Atlanta Fed. The Atlanta Federal Reserve Branch runs a projection on a go-forward basis. Almost right near the end of the quarter, it was still expecting about a plus 0.3 for third quarter. Positive, but not very positive. Then a big spike up towards the end of the quarter, which of course led to some questioning. Well, okay, what's going on here? And I had the question myself. Well, it turns out that their expectation plus some other very trusted sources say that that rally up will be from net trade, like the import-export trade-off, which we usually end up negative on. So good news is we ended up there positive. The rub of that is that doesn't tend to last very long. And one big reason for that is we're acquiring less inventory. So take that for what it's worth. But the good news is no matter how you calculate it, it does look like it will finish solidly positive. Why is that good news? Because on the right-hand side, we can see the components of GDP, us, people here, all of us on the call and everyone around us, we are over 2/3. It's approaching 70% of consumption. All right, so we need to maintain the willingness and the ability to make purchases, right? As an advanced economy, that's where our drivers are. And we need to see that number continue to grow in order to see better numbers going forward.
Yeah, Bryan, one thing that jumps out on this chart, 17.5% of our GDP is government spending. With interest rates moving up, how do you think debt service of the national debt impacts GDP in terms of going forward? Obviously, we're going to address the election later on. There will be a debt cap debate in Congress coming up. How does the government debt impact GDP in terms of those rising rates?
I'm going to give you a little bit of a bad news catch here. The debt service on national debt, because of the increase in rates and the number of the amount of that debt that is subject to changes in those rates, is double what it was a year ago. That's literally double. It was somewhere in the 400 billion, now somewhere in the 800 billion sort of category, could be approaching $1 trillion. That's just that's the nature of the beast. As we all know, whenever your adjustable rates adjust up, the amount you have to pay in interest is of course higher. That will have some drag. That's another aspect where there will be much scrutiny on how long rates will be higher than some would like them to be, and then what is the projection for those going forwards thereafter.
Thank you, Bryan. Yeah, I asked you a question at the start of this section of the presentation, which is the economy still strong? That's probably not the right question to ask. The question that we probably want to ask is, how weak will the economy get? And this chart really shows expectations from a CEO standpoint of what Fortune 500 CEOs are expecting. On the left side, you see the new orders index. And every time the new orders index has gotten as low as it is now, we've had a recession. On the right side, you see CEO confidence. CEO confidence has dropped like a rock. I think 85% of S&P 500 CEOs are now expecting a recession next year. Now, the good news as an investor is that GDP growth in an expanding economy and stock market returns are not perfectly correlated. In fact, there's a lot of uncorrelated aspects to your investment returns and the economic growth. And the reason for that is that stocks start to price in a recovery well in advance of that recovery happening. In fact, it's typically been about 6 months in advance of when you would expect a return to growth. Now, we're not trying to predict the exact date that growth will return or that a recession will end, but as a stock market investor, a lot of the action that we've seen in prices reflects that expectation of a recession. So should you sell today and sit in cash until you see the economy coming back to growth? Absolutely not. Our view is you should be invested, because when we do return to growth, you will have already seen the stock market reflect that uptick. Here's a few more statistics about where our economy currently is. Unemployment is probably the most important single statistic in terms of the health of our economy. Bryan, what are we expecting for unemployment?
Sure. So what we have on here are two aspects that are keeping growth rates and call it inflation rates even higher than we would like, than the Fed especially would like. On the left-hand side, you have unemployment. Unfortunately, most forecasts are almost universally are that unemployment will get higher, and I would kind of have to say have to get higher. Wage growth pressure has driven a large amount of discretionary activity. And I said before, I don't want to talk out of both sides of my mouth. We need consumers to consume and to act. We just need them to take a bit of a break, take a bit of a pause. One way to do that, unfortunately, is going to be some curtailing in employment levels, because there are some companies out there that are getting pretty stretched, et cetera. So what this is looking at is a projection by Bank of America about a period of time, and that's about not 6 months, excuse me, not 6 or 7 months of negative payroll expectations. We have had, the biggest spike in unemployment, temporary unemployment, rally back up out of that. It's huge swings again, just like on the GDP side. Unemployment rates are at or near the lowest of all time. We do need some cooling there. That blue trend line, the lighter blue trend line, would say that in their projection, we will get up to about 5%, which for those of us that have taken economics classes, in my experience, was always looked at as sort of the standard, right? That was in some analysis, full employment. Get to about that level, come back down again, to get to a more normalized scale. The right-hand side is another area that has led to some significant pricing pressures. This would be houses. The top chart there is going back to about 2010 with what the standard 30-year mortgage is, the 30-year mortgage rate. Going back for about the last 25 years, the average has been right around 5, right? So to think of that as my midpoint, how low did they get? At the start of this year, 3, or even a bit under 3 for many of us out there. Where are they at now? The highest they got to last week, 7.4. So there's another area where the swings have been incredibly dramatic. What is one effect of having higher mortgage rates? It brings down prices, right? If I have a payment level in mind, $2,000 a month, whatever it is, do that math. There are lots of calculators out there to tell me what I can afford. If what I can afford is less, we get a phenomenon like we see in that red chart down below. This is the percentage of houses nationwide for sale that have had a reduction in price. No, that number is very hard to read probably. It's 22%, approaching 1 out of every 4. The more recent stats I've seen even than this say it is now 1 out of 4, right? So we're still seeing transaction activity. Number came out today. House sales are still not weak. The house prices are weakening. For all of us homeowners out there, sorry to say it, we need that.
Yeah, so the headwinds in the housing market, as well as expectations for higher unemployment, both do support that pivot. Really, the one piece of information we're still waiting on is that inflation data, and that shelter data really is the final piece of the puzzle. But let's look at internationally what's happening, because this is not a US phenomenon. This is a global phenomenon. And this shows really a lot of the major economies around the globe. And you can see lowered growth expectations across the board. In fact, in many ways, the US is the cleanest dirty shirt in the laundry right now. And that's a big part of why we've seen such a flight to the dollar this year. Relative to most major currencies, the dollar has rallied significantly. And that's really been a drag on international investments, which are actually performing okay on a currency adjusted basis or unadjusted basis. But when you translate that back into dollars, you've seen losses in those international investments. But I do think that this bodes well for the US economy. It's continuing to compete relatively well against the rest of the world. You do have some faster growing emerging economies out there that also come with greater risks. But in the developed world, the US has been a standout. Let's look at this a different way. Bryan, here's something called the misery index, and not something you made up.
No.
What is the misery index, and how's it relevant to U.S. investors?
I get all the fun charts today, right? So the misery index is a way to plot on an X and Y axis two factors, two that are very important that we've already talked about today, but this is a great comparison to other places. Unemployment rate on the left, CPI on the right, inflation. What do we know is that Japan, way over in that green area, there's one country, that's Japan. They have tried to create inflation, try to stoke up inflation. They can't do it. They have tried. They haven't tried. They've always had a very low unemployment rate. That's just sort of part of their cultural structure. Okay, they're on the left-hand side. A couple of examples on the far right-hand side. Spain and Greece, they've got a reputation, especially Greece, as being Europe's problem children. That hasn't changed. A high unemployment rate and a high inflation rate is not a great combination. All right, what do we see in that clustered area in the middle? A whole lot of developed countries, many of which have been getting a lot of attention along with us. But let's talk about us. Where do we stand? We are right on about that 4% unemployment rate line. That is exactly right. No, we're actually a modest bit under that. Where are we at on the CPI side? We are higher than we would like to be for sure. We're not alone though, right? I think that's part of this is, lots of talk about how, this country is as high as us and that country is as high as us. It's true. And every one of us is going to have to figure out how to nuance a drop in CPI with some sort of mitigation in unemployment. What really jumps out to me here is how many countries are higher than us in unemployment that might not get thought about. But what we know for us here in this country is that the Fed, the Federal Reserve, has that dual mandate to try to have some levers on both of these numbers. Unfortunately, unemployment will have to likely go up for the CPI to move to the left.
All right, so let's move on to the question that really everybody dialed in today to ask is, can markets rally from here? And I think there's really two questions this is asking. One, can stocks rally from here? And two, can bonds stop falling from here? Can we earn the cash flow and the yields that bonds have on their coupons and begin to have positive returns? As we've hinted earlier in the presentation, just to kind of beat you to the punch here, we believe the answer to be yes for both of those questions, but we'll talk about a few reasons why on the next few slides. Valuations look attractive on the left side, and a fearful mood usually means upside ahead on the right-hand side. And you can see on the left, we'll start over there. This shows the S&P 500 since 1996, and really these big inflection points. You can see all of the bull markets really have higher valuations at their peak, with the exception really being the October 2007 housing crisis, which was caused by a fundamental problem in our economy through the housing market. But looking at those valuations, they're typically been in the 20s. This year was no exception. We had a valuation of 21 on a forward PE ratio of the S&P 500 on June 3rd, which was the all-time high. We've dropped about 25%. Market has rallied back. We're closer to 20% today than that 25% number on September 30th. But as of September 30th, the PE ratio had dropped to 15. 15 from a historical standpoint is not expensive. And that gives us some comfort that yes, stocks, they could go down more, but you're not buying at those elevated PE values. You're getting into the market at these levels at a fairly reasonable price. And especially if you look at maybe some of the value sectors of the market versus some of the growth sectors, you can find stocks that are trading close to or at historically significant discounts. We think that's an attractive opportunity for investors. If you look on the right side of this chart, and this is the fear versus greed index, the top, investors are being greedy. They're chasing money. They're chasing performance. On the bottom, investors are selling risk. They're buying cash. And we're at an extreme level in terms of fearful investors. It's difficult to find positive sentiment out there for as an investor. There's just a lot of negativity. A lot of investors have gone to cash or sold their stocks. And those that are left, we think have an opportunity. So we continue to advocate owning your stocks, sticking with it. What about bonds, Bryan?
So bonds, this is probably the ugliest chart to me in the entire book. What's happened here is stocks being down the level that they are and I saw it on, I said it, excuse me, on the very first slide, going back to the beginning. That is disappointing, but not unusual, right? Stocks have intra-year, within a year drops, excuse me, almost every single year, and they very often get to double digits. What is unusual and what is completely historically out of the norm, the significant and shocking, really, drop in bond values. So what do we have here? Left-hand side, 2003 to through the end of September 2022. This is not just treasuries, because remember, there are more bonds than treasuries, although many times they just get referenced as those. These are all investment grade bonds. From 2003 to 2012, we had 0 negative years. We had some leaner years. We had no negative years. Then what happened in 2013? Rates were cut so low, and if you look at those previous years, 9, 10, and 11, and 12, returns got so high relative to the amount being paid by the coupons, the amount actually pledged to the bondholders, we saw a negative return. That's surprising. Big rally up, negative return. So we had sort of this dance for a while of slightly negative and then probably bigger upside than we should. Then we got to 2019 and 20 and the wheels came off, but on what felt like at the time upside. I'll say this, logic left the building. You should not get a 17% and an 11% return in an environment where a coupon, the amount actually pledged to be paid to the bondholder, is 2% a year or 3% a year. Why did that happen? Because of a kind of common thought process out there that the Fed would not raise rates anytime soon, and especially not to the degree that we have seen. And so overpaying for longer bonds that had a modestly higher coupon seemed okay. What have we seen this year? It's not okay, right? Once again, logic has won out eventually, and we have this massive drop. And my clients have heard me say this sometimes in meetings. Why are we down this much this year in bonds? The exact polar opposite reason we were up so much for those 2 years. But like the title says, those excessive bond returns have been flushed out. Kind of look at it as almost hitting the reset button. And let's look forward. Right-hand side, high yield bonds, junk bonds, which keep in mind come with much higher risk, as the name would imply, than those investment grade ones, are giving an average yield of over 9. The situation there is tread cautiously. The default rates, if and when we do go into I assume a mild recession, you will see higher default rates. Which ones will they be? That remains to be seen. How about down below, investment grade? Look at this opportunity set. The average yield, and that number, hopefully you can all see that, over 5.5%. Right, so that's not a 30-year long treasury. That's not a low grade bond. That's an investment grade, just general standard bond, 5.5%. That's fantastic. The problems have been mostly flushed out on the bond side. Let's look at opportunities going forward.
Yeah, and I do want to highlight something on the chart on the left, because there's some very big upside and some big downside numbers there. But that bond ETF example includes longer term bonds, which has been the primary driver for those big swings. Our recommendations at Cutler have been to keep duration shorter. So to have shorter duration in the bond markets, that meant we didn't quite get as much as upside in 2019 and through 2020. But it also means that broadly speaking, our recommendations were not getting as much downside this year. Going forward, we're more neutral on the bond market, as Bryan said. We don't want to have such a strong bet for shorter term bonds because of this sell-off and the opportunities that it's presented for bond investors. So we suggest bond investors begin to push those 1 to 3 year holdings out to maybe a 3 to 5 year holding, or 5 to 7 years, depending on where your bond portfolios are currently positioned. All right, so Bryan, we got 2 more slides here to talk about how are households doing and how does this impact stocks?
All right, let's start with the first of the 2 good slides to end the presentation. The good news here, households, we are still in good shape. Federal financing, there's some situations there. On a household level, we look really good. How good do we look? Left-hand side here is comparing the last quarter of 2019 to the second quarter of 2022. So this is after going through the entire pandemic period and then popping out the other side. Every single percentile here, and this is broken out by aggregate wealth of households, right? 0 to 20, all the way to the top 1% that get their own on here. But look at like the 80th to the 100th, almost together. they have all experienced sizable increases in the value of their households, right? That has come from appreciation of real estate, appreciation of stocks, that has come from higher cash balances. We are, the good news of this to me is that we are seeing uniformly that those have increased, right? Of course, the dollar values obviously will be higher as you drift further to the right because there's more dollars to start with, but I like that uniformity of spread. On the right-hand side, this is another way to look at really what we're seeing on the left. That bar chart there is the consumer balance sheets. If anybody came into my office and said, "Oh, how am I doing? My assets are 9-to-1 versus my liabilities," I'd say, "I love it. This looks great." All right, let's talk about specifics and make sure you're where you want to be. But that's a great start. And they also like there is the diversity, that we don't have all of our eggs in one basket of where those sources are coming from. Homes, a little more than a quarter. Financial assets, brokerage accounts, et cetera, less than half, right? Almost 40%. The rest is divvied up between pension funds. Yes, those still exist. And things like cash deposits. Great. Okay, we have a nice spread there. We're not too dependent on one aspect or another. How about on the liability side? 2/3 of it is in mortgages. Okay, I said before that mortgage rates have gone up. The good news is more Americans have fixed rate mortgages. And I know from experience, many of us, I'll say us because I did it too, refinanced to take advantage of low rates, that this is not something here in America that should be something that could be like a bear trap that could catch us with rates escalating. Unfortunately, there are some that will happen too, but that's just, the way things go. And also 7.5% for anyone getting a new mortgage, historically speaking, is not that high anyway. It's higher, but it's not high on an absolute level. The other aspects of that, student debt gets a lot of attention, sure, on a, it's a high number, but relative to overall balance sheets, it's not bad. How do I know that debt service is not something that I'm currently concerned with? Top right there. Even though it has gone up from its low point, it is still far below where we were back in the 07, 08 sort of a situation. So anyone who thinks that we're back to there, no, we're not back to there. One area of concern, it's fair to call it concern for looking forward, the bottom right. Our savings rate during kind of economic freeze time there, where we were during the pandemic, really increased, right? And it was increasing on a monthly basis. That has started to turn. We wanted that to turn because, again, we're a consumer-based economy. However, what we're seeing now is some pretty noticeable trend lines of some credit stretching. If you go to the left-hand chart, that's mostly, to no surprise, in those first two quintiles, I guess I would call those, 0 to 20 and 20 to 40. But if that does start to spread a bit further, that's something to watch out for on a go-forward basis, especially to reference a previous chart. Debt service does get higher as interest rates climb. Not a concern right now on an absolute level, something to watch for.
Yeah, Brian, and this chart really says to me that the recession that we're expecting may not be that deep because we do have a consumer-based economy and consumers are not as wealthy as they've ever been, but close to that. And I think that bodes well for how we might weather this storm as an economy coming forward. Let's look at one final chart, and this might be my favorite chart or page of the presentation. And this is the election slide. And we get asked about this in every meeting. How's the election going to impact stocks? And on the left side, you can see typically from May to October, stocks return close to 2%. But during midterm election years, that's the only red bar on this chart. Stocks have negative returns from May to October, and that has played out this year almost perfectly as we've seen this big sell-off leading up into an election. Well, normally after October, from November through April, stocks have an average return of 7%. But after midterm elections, stocks have an average return of almost 15%. So midterm elections, getting that uncertainty behind us has been very positive for stocks in the past. And, we feel like this year might not be an exception. You go back to 1939, we have not had a negative year after a midterm election since 1939. That's over 20 consecutive midterm elections that have subsequently had positive returns. So we feel really good about the historical record there. Obviously, looking forward, there's no guarantees, but the past has a pretty good record. What about the current political makeup in Washington? How is that going to impact stocks? And, it looks like right now that we will either have a Republican Congress or a split Congress with a Republican Senate or a Democrat Senate and a Republican House. How has stocks done under each of those scenarios? Well, if you look at the right side, with a Democratic president and a Republican Congress, if it's a unified Congress, stocks have an average return of 13%. That's actually the second highest number in terms of the political makeup in Washington. What's the highest number? It's a Democratic president with a split Congress. So half Republican, half Democrat. And that's the other possibility that we're looking for. So both of those political scenarios, which as an outside observer might look like gridlock, as a stock market investor might look like a potential good environment for stocks moving forward. So the election, we think, is going to be positive for stocks, regardless of what the outcome is. And getting that behind us will really allow stocks to set up nicely heading into 2023. And then we can look for the Fed to drive policy from there. And with that, I just want to thank everybody for joining us today. Bryan and I are always available to answer any questions you might have. Please reach out to your advisor if you want to dig deeper into any of these topics and kind of challenge Bryan and I or compliment Bryan and I. We'll take either approach would be fine. But thank you for joining us today, and we appreciate your time.
Thank you, everybody.